Hey traders and investors, it's Serge Berger here. Today I want to talk about the very straightforward concept, but much more difficult thing to actually implement, which is called staying the trend. And we talk about this a lot when it comes to sort of the more active investing slash trading type of style, which doesn't include something like day trading, but it's more position trading of positions sort of lasting at least a few days to a few weeks. I want to take the example here of the S&P 500 because it's really a pretty good example and really want to talk about the most recent dip we saw in late July and early August, and what we've seen since was a very sharp rally. Before we look at that, just sort of keep this picture in mind. S&P 100 still trending higher. It hasn't broken any major support lines as such. It actually bounced more or less where it should have. And that's the 100-day simple moving average. This blue line here that I discussed this with subscribers in real time as we got to that level, said that we could get a breakdown and then a quick return back up, or we just hold it right away. But either way, it was a good likelihood of holding a trend. So what does this mean from a trend perspective, and really how should we trade this? From my point of view, it certainly was not an area I would have shorted this the index, and we didn't. In fact, we actually we started buying here for a bounce. That bounce has then turned into a trend and into another bounce, more meaningful bounce higher. And from a trading point of view, this is not something you want to short until you actually see a bearish reversal take place. There's plenty of reasons to slowly become bearish here in the broader market. In fact, I do think we're going to get a more meaningful correction at some point here over the next probably the next 2 months, and then maybe again in early 2015. But that's just my sort of roadmap in terms of actually trading this. It's dumb to short into this market until you have some sort of bearish reversal if you have an active investing approach. If you are day trading or like have sort of a longer sort of multi-month sort of time frame, yes, you can always short into this, but it's frustrating to keep on short positions or long positions for that matter if they go against you for more than a couple of weeks. So from my point of view, and I think most, or if probably all of my subscribers and certainly investors find it much easier to just kind of stay the trend and switch to the long side when market it continues to go higher. And this was a really good example here. This oversold bounce, which we initially treated as an oversold bounce, and then started taking profits, and then once it turned into a more meaningful bounce, we bought again, and now it looks like we can have a little bit of a move higher at least. And then and you see this in plenty of stocks rotating higher. Some social media stocks are getting bids, and momentum stocks like that. So when you see that kind of stuff, you do take some net long exposure, but you got to be very quick in flipping the switch when the broader market gives you a bearish outside day or a bearish reversal day, which is really what you want to look for confirmation to get short the market. So stay the trend until it ends, but don't fight it. Don't fight it too early. Hope this makes sense. If you've got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader, and I'll see you in the next video.